Ladies and gentlemen, good afternoon and thank you for joining. It's a pleasure to see you all today. And many of our team are joining from the office, which we're thrilled about. The plan is for our team to talk for about 25 minutes on the performance of the World Stars and our views on the outlook, followed by Q&A. Thank you for the excellent questions already submitted, and do send more if you wish. You will see one or two new features in this webinar, including some comments on new stocks we've added in the last 12 months. Could I please ask you to note the disclaimer? Now it gives me pleasure to introduce Jerome Stern, Managing Partner and Principal of the Stern family.
Thank you, Sandy. Good afternoon to everyone who has joined us. Thank you for taking the time. I would like to add my welcome to J. Stern & Co.'s World Stars Global Equity Investment Update Seminar. I will briefly introduce the firm and World Stars before handing over to Chris. You can see that Chris and I are joined today by Giles Tulloch, our Internet and Technology Analyst, who has been with the firm since 2014 and recently joined the partnership. Our business continues to make good progress with AUM now well over $1 billion, supported by strong performance and inflows. About 25% of our assets are owned by my family and the partners, and the balance by other families, charities, trustees, and institutions. Our World Star strategy is now 8.5 years old and continues to deliver results well ahead of our target return of 8 to 10% per annum or more over the long term. It invests in a concentrated group of 20 to 30 high quality, sustainable, global large caps with enduring competitive advantage and a long runway of growth, selected on the basis of our intensive in-house fundamental research. Quality is the defining condition for a stock to be selected, followed by value. In the last 2 years, we have fully integrated ESG in our in-house research process. The strategy has been managed by the same team since 2014, and investors can invest in World Stars either through separate managed accounts or through our UCITS fund. With World Stars, we enable our clients to invest alongside my family in a strategy that has successfully generated strong returns over more than 60 years. Over the last 5 years, up to the 23rd of April 2021, our World Stars Global Equity Fund has grown at 16.2% CAGR in USD, and over the last 3 years by 14.5% per annum, both significantly ahead of the MSCI World Index. In calendar 2020, it rose 19.4%, 2.9% ahead of the MSCI World Index. Year to date, our fund grew by 8.8%. Since November last year, there has been a marked rotation in favor of value stocks, which had previously underperformed and away from growth. This type of rotation often occurs when equity markets pass an inflection point. Although March 23rd last year was the most dramatic turning point of 2020, during November, there was a significant burst of optimism triggered by successful vaccine trials and the start of major vaccine rollouts, as well as new leadership in the United States. This acceleration of recovery prospects favored value companies and sectors which previously had been under severe pressure. Most recently, progress in the equity markets has broadened out as investors recognized the opportunity to buy genuine, long-term growth companies at much lower valuations. We remain optimistic over the prospect of a substantial global recovery over the next 2 to 3 years, and confident in the ability of our focused portfolio to continue to deliver further significant value over time. I will now hand over to Chris.
Thank you, Jerome, and Welcome also from me to all of you who have joined us. We look forward to an interesting discussion and hope to provide some information in our remarks and then to have a lively Q&A that follows. I just want to very briefly highlight again what we mean by quality and value, to echo the points Jerome has made, to restate them for those of you who are regular listeners, and to explain them for those who are joining us for the first time. So as we said, for us, quality is a gating condition of what we do. If a stock does not have the quality we're looking for, it can be as cheap as it wants, and we won't buy it. We have 4 key criteria for what we mean by quality. It's a strong and sustainable competitive position in a good and growing industry, with a management team with a track record of value creation and the financial strength to weather any kind of adversity, including the type of situation that we've been going through with the COVID pandemic now for well over a year. So for us, these are the key issues that we're looking for, and it is a forward-looking definition of quality. We do screening to identify consistency and other types of measures, but we're concerned with what companies will do going forward, what kind of business they have, why they have competitive advantage, and why that competitive advantage is likely to be sustainable. And one very important point that we will highlight as we go along is that sustainability has always been a crucial part of what we do. We don't believe that it's possible to generate sustainable returns without investing in sustainable companies. And that means companies that have a process and a approach by which they maintain their sustainability, they treat their resources sustainably, their employees, their customers, their suppliers, and their other stakeholders. So for us, sustainability is a key element of what we do. It's also because we think that we are in a world where it's about OpEx, not CapEx, where it's about intellectual capital, not physical capital, and where it's about the cash flows that companies generate and not some kind of return on some kind of tangible or intangible capital that may have been generated by some kind of transaction, but rather the ongoing quality of the cash flows that companies can generate. And we will get into then and explain the implications that that also has for our portfolio, and in particular in terms of issues like the carbon footprint that it has. For us, value is the ability to buy those companies at prices that allow us to generate our target returns of 8 to 10% or more over the long term. And as Jerome just showed you, we've been able to do that since the inception of the portfolio in 2012 and more recently. If we turn then to the portfolio composition, you can see that the portfolio continues to be extremely diversified. It's entirely invested in companies that are listed in the US and in Europe, so in the safest markets, with the greatest corporate governance, the longest track records, and the strongest alignment between shareholders and companies. Yet it continues to be completely global in terms of its underlying exposure. So you can see 46% underlying exposure in terms of where companies do business to the US, 20% to Europe, and the remainder to the rest of the world, much of which is Asia. These are numbers that we add up ourselves from the individual numbers that companies report. If you think of it then in terms of the sector allocation on the upper left-hand side, the GIC sectors, the standard sectors used to identify the exposure, are extremely diversified. Our approach of quality investing takes us to certain types of sectors and not others. So we like ones that have some kind of recurring revenue, that have the types of criteria we're looking for. And on the upper right-hand side, you can see our own allocation, which is 30% to digital transformation, 20% each roughly to healthcare and consumer, and 20% to industrials. And the point that I want to highlight is that while we have a definition that is very much around what companies can do over the long term, we also have exposure to companies that could be considered value, both in terms of their valuations in a number of cases across these different drivers, but in particular also in terms of companies that have industrial and infrastructure type exposure. So it's a holistic approach that is diversified and that allows us to identify companies with different types of drivers and factor exposure and to generate value from investing in them. And I want to turn then to explain just a bit more in terms of the breadth of this long-term potential that we have, because one aspect of what we do in terms of the drivers is to invest in what ultimately end up being industries and sectors, as we've highlighted. But it is also about then finding the right companies within those industries and sectors. And that's what we've shown here. The black bar is the performance that we've achieved within these different allocation areas. The light blue bar is the performance of the same sector in the MSCI world. And as you can see, we are very much able, this is the year-to-date performance of 2021, to add value above and beyond the exposure to the underlying indices. We've done this analysis over the different periods of time in which we've managed the portfolio, and the pattern is similar, but it is very important for us to be invested in the right types of areas, but to be able to find the right types of companies so that we generate the best possible value. One of the issues that we've identified is this question of sustainability. So I want to turn just briefly again to what we mean by that and what the outcome is in terms of the ESG approach that we have taken. We've integrated ESG entirely into our investment framework. We follow the framework of materiality by SASB, which we think is the leading organization that is looking to create standards that we can use to have uniformity across investors in terms of the exposures that companies have to ESG issues. And we're members and sustainers of SASB. As you can see, we use a traffic light system that goes from dark green to bright red. You can see here that the portfolio in terms of the individual companies and their exposures is entirely a dark green, light green, yellow for areas where we think there are issues that warrant follow-up, or gray for areas where we think there's no material exposure. So for us, that is confirmatory of the approach, and I think directly linked to the definition of quality, because companies that are forward-looking, that are less capital intensive, are also less likely to be resource intensive or to be relying on invested capital that is often disrupted, but also carbon intensive or polluting in order to generate the returns that they do. And turning then to the actual impact, we've added up the carbon intensity of the World Stars portfolio. And as you can see, the portfolio has a quarter of the impact in terms of carbon intensity of the MSCI world, and a fifth of the S&P 500. So very substantially lower. It is our conviction that over time, this also means that the companies that we've invested in will do better than the companies that are in these indices. But in particular, it means we have selected businesses whose impact is significantly less and who therefore will contribute very substantially to the achievement of the goals that have been set by the UN Sustainable Development Goals and by the other frameworks that we subscribe to and that we think are becoming increasingly important in terms of the industry and the drivers for investment returns that we will be held accountable for. So then I want to turn to the question of that Jerome talked about in terms of the sector rotation. One of the things with our long-term approach is that we believe that volatility is an opportunity for long-term investors, because short-term market moves imply some kind of short-term reaction by investors, which is often an overreaction that people suffer, and that leads to opportunities for those people who can look through those and who can take advantage. We think the same is true for sector rotation. So where they're driven by flows, by reactions to short-term changes to the environment or perceived impacts from economic issues, they lead to opportunities as well. We wanted to say here where we view ourselves as being positioned. So this is just a chart of looking on one axis on earnings per share growth and on the other axis on price to earnings multiples. And we've identified the blue box as one that is more generally about growth, the red box as the one that is more generally about value, primarily defined as around price to earnings ratios. In an environment like we're in right now, where there's a significant impact and where therefore both growth rates and price to earnings ratios are impacted by the short-term impact on earnings. This, of course, has to be put into perspective. But still, you can see where the cluster is of the stocks that we're invested in and that comprise the world stars. And you can see in blue the dot that defines the world stars itself. So you can see we're invested in companies that have very sensible earnings growth. It's often on the compounding side. So it is not so much companies that have very substantial earnings growth that is going to be related to the recovery from heavily impacted levels, as opposed to sensible recovery from the levels that they've achieved. And we are invested in companies that have what we believe are moderate valuations that are entirely compatible with the goals that we're looking to achieve. So it's within that area that we operate and that we're looking to invest in globally leading companies, some with market caps in the hundreds of billions into the trillions, but some, roughly half, global mid caps with market caps of 25 to 50 billion that we believe can double and quadruple over time. So with that illustration, I think it's interesting to see what the impact of the sector rotation has been. Here you see bar charts of the sort that we show you from time to time. These ones are for the year-to-date stock returns of the stocks in the World Stars portfolio, grouped by the underlying drivers that we invest in. You see that the white bar there with the 8.8% is the annual return year-to-date for the World Stars Global Equity Fund. But it's very interesting to note the pattern for the companies that have done particularly well. And I think it's important to note that the rotation that we've talked about has already started to reverse in the last couple of weeks, but it's still quite remarkable. The single best performing stock in the dark color is Alphabet, which is a digital stock, but which was held back last year in good part because of concerns around online advertising. So among the digital leaders that we own, it's probably the most cyclical and the one most geared to real and perceived changes and increases, in particular in ad spending. And I think that's the explanation for its exceptional performance on a year-to-date basis. But the other ones are companies like LVMH, like Eaton, the US capital goods company, Diageo, the spirits company, Alcon, the healthcare company, that all of which have been impacted in one form or another by the issues that we've seen, and that are in the process of recovering. So that is the impact of the rotation on our portfolio. It's equally interesting to see the stocks that have not done well. So on the bottom, some of them are the companies that you would expect, but it's interesting to see that two of those dark bars are Amazon and Adobe, companies that we've owned for a long time. Amazon since we launched the portfolio, Adobe for more than 5 years, and they have barely contributed in a market that has been obviously positive and that has been anticipating the recovery that we're looking at. So this is what you can see, but like with looking at the charts from last year that have a similar pattern, for us, this is a question of opportunity because we think that the companies that have recovery potential will continue to do so, while the ones that have been held back will enjoy a rebound. And where that's been true for value since November last year, when this rotation began, we believe that the trade is now in the process of moving on, and it is favoring the companies that have been held back. If you then look at what this actually has meant in terms of performance for the market and for our portfolio, you can see here on the left-hand side, this is growth versus value of the last 5 years. It's simply the bottom and top quintiles of valuations within the S&P 500, and you can see that growth has dramatically outperformed, but that value has most recently enjoyed a rebound. And then in the first quarter of this year, the chart on the right-hand side, you can see that at the peak, this rotation that reversed in part the outperformance of growth at the peak was about 16%. Those are the blue and the black lines. So it's interesting to note the dotted red lines are what's happened since the end of March. And so it is very interesting to see that value has flatlined since then, and there's nothing wrong with that, but that growth has significantly started to significantly perform and to close the gap again. That's exactly what I was trying to say, and that is reflected in our obviously much larger and more stable companies that have greater quality, that operate in the middle of these extremes in terms of the quintiles, but still follow a similar pattern. And that's why I wanted to talk about the stocks and the trading that we've done to take advantage of it. Because effectively, again, we think that on the long term, our trade is quality. But last year, we were buying stocks that would be considered more value stocks. When we saw that opportunity, those are the acquisitions of Sika and Amphenol, capital goods companies that are extraordinarily resilient and have had phenomenal results and performance since then, of Givaudan, which is a flavors and fragrance company that is to food what Hermès is to luxury, simply the #1 company in an absolutely crucial part of the industry with exceptional sales and margin potential, and Alcon, the global leader in eye care, that we bought in the first and second quarter of last year, and then we bought Visa, adding to a position in MasterCard, the payments company, which has been held back by concerns around consumer spending, in particular in terms of hospitality and travel, which are high margin parts of what they do. So this is us at that point buying stocks that have been held back and that have been impacted because of the outcome of the pandemic. And this year, we think that the trade has moved on, and we've bought a stock that would be considered more growth, which is Salesforce, the market leader in SaaS, and that is a company we've been looking at for a long time, that we have greatly liked from a fundamental perspective, that we thought was somewhat fully priced and held back, but that because of this rotation that took place, because of its increase in earnings, but its stock price performance became an exceptional opportunity that we added to the portfolio this year. So with that, I want to turn to Giles, our internet and technology analyst who has been working on Salesforce, and ask him to give us an introduction and overview of the investment. Giles?
Great. Thanks a lot, Chris, for that introduction there. So yeah, I'd love to talk to you a little bit more about sort of Salesforce and why we bought it this year. So it's a great company. We've known it for more than a decade, and we think right now it's about to enter a new phase of its growth. By way of background, it's best known for CRM, that's customer relationship management software, and according to IDC, it's got about a 20% share of this market. What's important though, is that if you look at that chart there, the next 4 largest companies combined don't reach Salesforce's market share. This really does reinforce the strong competitive moat that the company has. It's got over 150,000 customers, ranging from small businesses right up to the largest Fortune 500 companies. It's also, as Chris said, a pioneer of SaaS, or software as a service. This is where software is deployed on the cloud and is billed on a subscription basis. We think we're still very early in this generational trend towards cloud computing. So Salesforce, what it does is that it takes its leadership position in CRM software and it employs what they call a land and expand strategy, whereby it sells complementary software around this to its customer base. This has enabled it to enter 7 markets, vastly increasing its target addressable market. By way of example, the company said at its most recent analyst day that their customer from 4 years ago now consumes twice as much content. What's also important though about this target addressable market is that it's growing, and we think it's going to grow even faster due to the pandemic. What had previously been talked about by companies and enterprises as digital transformation, it had been a bit of a buzzword, but now with the pandemic, it's become a necessity. Enterprises have realized without face-to-face communication with its customers, it didn't really have enough data. It didn't really understand how best to serve their customers and how best to service them. This is exactly the products that Salesforce sells. To reinforce this, Morgan Stanley, they did a survey of sort of CIOs of large Fortune 500 companies about what their IT spending plans would be for this year. Unsurprisingly to us, digital transformation was the top priority, followed by cloud computing and data analytics. We really think there's much more growth ahead for Salesforce. But that's not to say that Salesforce hasn't had strong growth already. It compounds up very quickly, its growth. It has done over 20% revenue growth each and every single year for the last decade. This has meant the company has been the fastest software company to grow to 5 billion, 10 billion, and 20 billion in revenues. It also does this on a subscription basis, which means that this revenue is recurring. As we pointed out before, we think this growth is going to continue. It's got a growing market, it's got a leadership position, and it's also got this complementary software to land and expand. With 180 billion target addressable market by 2024, we think that'll be 200 billion within the next 5 years. Salesforce have set an ambitious goal of 50 billion in revenue. We think they'll definitely achieve that. Another part of our investment case is the margin potential. Whilst it is true that Salesforce does spend a lot of money on sales and marketing right now, which depresses its operating margins, we think it's important for the company to really seed the market and for its current growth. But as it will mature and it will reach scale, these margins will increase, and we think it will follow a similar path to other leading software companies like Adobe and Microsoft. Also, with much more enterprise business, the attrition will be less, and it's also cheaper to serve the customers as well. We think as such, Salesforce can probably reach mid-20s to high 20s operating margins. So before sort of the end of the year, the shares had fallen. Chris had mentioned this rotation away from sort of the growth stocks into value stocks. And also Salesforce had done a proposed acquisition of Slack. We think the company have got a great track record in terms of M&A, and that Slack could be a very integral part of its product stack with its communication tools. As such, we decided to pounce and we bought shares. So to summarize, we think the end market is growing for Salesforce. We think that COVID is going to accelerate it. We think they've got an unassailable leading position. And we also think the business model can deliver much higher operating margins. If we put it on a valuation like other leading software companies, like say Adobe, we think the company can easily double from here. And so with that, I'll pass it back to you, Chris.
Thank you, Giles, and for that. And we're very happy to go into more detail on the investment case for this, or to talk about other companies in the portfolio in the Q&A. So please do let us know if you'd like to have more of a discussion and more details about the investment thesis here. I would just now like to turn to the outlook that we have, and first of all, talk about where we think we are in terms of understanding the impact of the pandemic, and where we might be in terms of how we will have a return to normality. One of our investment gurus, Charlie Munger, has a great quote that says about quantitative easing, if you think you understand it, you probably haven't thought about it a lot. And we certainly think that the COVID pandemic is a very similar issue in which it is extremely difficult to understand what the right public policy response should be, and what the balance is between the measures that have been put into place in order to have social distancing and in order to protect populations versus the economic impact and the very complicated reality of the fight against the vaccine in terms of, in particular, against the disease, in particular in terms of the production of the vaccines and their rollout. It's just a rough framework that we have, but we think that we now, being now just over a year into the most critical phase, that we have had extraordinary progress, that the effort last year in terms of the production of vaccines, but also the increase in capacity of healthcare systems, the development of therapeutics, and therefore the mitigation of the worst outcomes has been extraordinary. And it's one of the most hopeful things that we've seen, how technology innovation have been able to drive the global response to the pandemic. And I think it's put us into a point where we can now look forward into the recovery. It's very clear that markets have been looking at that as well and pricing it in from the beginning of November, when we started to see both the further step up in performance and the rotation that we've talked about. But the really important point, I think, is to highlight that we're now in a phase where it is about the vaccine rollout itself. There are obviously certain issues around variants, and there are issues around the different vaccines and the potential side effects that they have, which thankfully continue to be rare, but are serious and will have to be considered. But very importantly, I think, is the example of the US, where you can see now that 80% of over 65-year-olds have already been vaccinated, and where the country is on track to have 80% of the population vaccinated by July, and that's likely everybody who wants the vaccine who's older than 16. And that 80% threshold for the vaccination is the threshold also for herd immunity. So while the situation will continue to be difficult, and we're highly cognizant of that, we think that there will be a very significant change as we go through the second half of this year and into next. And in particular, vaccines will become much more widely available. The debate in the US has shifted on the basis of these achievements to what to do with the billions of dollars of excess vaccines that will exist, both in terms of the Pfizer and Moderna vaccines, but also the J&J and other vaccines. So to some extent, it may be another case of the new world coming to the rescue of the old, or perhaps the rest of the world. And it is a testament to the dynamism of the US, its ability to develop these kinds of vaccines and to produce them at scale. But this is the situation that we're looking at. And thankfully, people have been, I think, understanding of the efforts that governments have made, and these risks that we've identified in terms of, in particular, the political unrest and financial instability, which would have been extremely serious, while we again have to take public response seriously and be wary, have not materialized, and therefore I think allow us to have a more constructive outlook. And so that is why we are constructive for 2021. We're obviously concerned about the impact of the pandemic and of the impact it has on all of us and people we know, both physically and psychologically. But we do think the vaccines will be effective. The thing about it is that it's hit the service economy. There are not that many pandemics that one can look at in terms of looking at the impacts, but where they can be identified, they are the shortest and sharpest impacts with the strongest V-shaped recoveries that exist, because once the exogenous event is addressed, there is then a resurgence. And that, I think, is what we will see now as well. So with the service economy being hit, the support from the government has been Keynesian, where people have had to spend the support that they've received. It's been stimulative, where they've been able to save it. It has dramatically increased the savings rates in many countries like the UK to near unprecedented levels, and means that people have capacity to spend. And that is what we're seeing. So we expect to see a significant resurgence in the overall global economy, in consumption, in investment, and in particular infrastructure and healthcare capabilities, all of which we're seeing governments actually implementing, including in the US finally an infrastructure plan that may take place after obviously having been discussed for decades. And I think the most important point within that is that we're also seeing it in the companies that we're invested in. So the reports that we've had both for last year, where they've been resilient, and the incoming reports now for the first quarter of this year have been nothing short of extraordinary. Some of the consumer companies like LVMH, but also companies like Pernod have reported very, very substantial increases in terms of their results, resilient and extraordinary numbers in the markets that are already open. And so we think that those bode extremely well. Companies in capital goods like Sika have had exceptional results and are showing increases in underlying demand and in backlog. And so we see this overall macro picture reflected in the results and in the outlooks of the companies that we've invested in. And ultimately, since we invest in quality and value, and we base our decisions on the fundamentals of the companies that we invest in, that is the best indication for what we think will occur. And it is what gives us confidence in the outlook and means, again, that for us, we should look at any kind of volatility that takes place going forward, including the possibility for further sector rotation as an opportunity to take advantage of it and to buy and to reinforce our positions in companies that have the prospects to generate value for the long term.